Hi there, my name is Kasha, and today we will be discussing the power of HSAs. So the Health Savings Account is a tax advantage account that was created in 2003, allowing you to pay for qualified medical expenses either right now or in the future. So what makes this plan so great? This plan is triple tax-free, meaning that the contributions, the money that you put into the account, is tax deductible. Your profit is tax deferred, so it grows income tax-free, no capital gains. And then lastly, the distributions that you take out for qualified medical expenses also do not get taxed. This is a little bit different than the FSA, the flexible spending account. The FSA is different because the funds expire at the end of the year. The HSA is great because your funds will roll over year after year, no matter if you're no longer with your employer or if you have a different insurance plan. And the main point of the video today is to talk about self-directing that HSA. That's right, your HSA can be self-directed, meaning you could use those funds to purchase real estate, private entities, cryptocurrency, life settlements, agricultural land, precious metals, the list goes on. I just wanted to share an interesting fact. The average couple retiring this year at age 65 will need about $300,000 to cover healthcare expenses. Oftentimes when we think about the future, we think about the house we're going to live in, how we're going to spoil our grandkids, what cruises we're going to take, but we overlook how much funds we will need to cover medical expenses. So who is eligible for this type of plan? The good news is that 56% of employers are currently offering HSAs to their employees. If you don't currently have an HSA and would like to start one, you just have to make sure you meet these 3 criteria. Number 1, you must be on a high deductible insurance plan. High deductible plan means higher deductible, lower monthly premiums. Number 2, you cannot be on Medicare. And number 3, you cannot be claimed as a dependent. So a high deductible insurance plan means that your minimum deductible for this year is $1,400 and your out-of-pocket maximum is $7,000 for an individual plan. If you are on a family plan, the minimum deductible is $2,800 and your out-of-pocket maximum is $14,000. In order to contribute to an HSA, again, you must meet the 3 criteria. You must have a high deductible plan, cannot be in Medicare, and cannot be claimed as a dependent. If you have an HSA from a current employer, maybe one that you set up many years ago, those funds you can definitely transfer over, even though you might not be eligible to start a new account or to contribute. Again, as I mentioned earlier, those funds are transferable and do not expire. So now let's talk about the contribution limits. For an individual plan, you can contribute $3,600 this year, and if you have a family plan, you can contribute $7,200. And great news, if you're age 55 or older, you can contribute an extra $1,000 as a catch-up. And as I mentioned earlier, these contributions are tax deductible. So now that we've discussed the contribution limits, who is eligible to contribute and start an HSA, I mentioned earlier that this plan was created to be used for qualified medical expenses. If you wish, you could utilize these funds tax-free to cover things such as acupuncture, dentist appointments, eye exams, purchasing contact lens solutions, hearing aids, wheelchairs. The list goes on and on. This is just a short list, mentioning only a few of the different products and services that your funds can use. If you wanted to take a look at the current list, simply visit the IRS website. And just to keep in mind, this list continues to grow. A few years ago, over-the-counter medicine was not on this list, and currently it is. Same thing with feminine hygiene products. I think in the future, we'll see this list get longer. And if you do use your HSA funds for those qualified medical expenses, just make sure you save your receipts in case of an audit. IRA Club offers 2 types of HSAs. The first is the debit card option. IRA Club will issue you a Visa debit card that you could use at your doctor's office, over the phone, or at your local Walgreens or CVS. This will allow you to use those funds right away for those qualified medical expenses. You will simply tell us how much funds you'd like in that account and either do an HSA transfer, or a contribution, or a combination of the both. Now, my favorite type of HSA account is the self-directed option. This type of account allows you to self-direct and invest in alternative assets. Why would someone want 2 accounts with IRA Club? So if you're thinking that you'll need to use funds for both the qualified medical expenses and you'd like to self-direct and invest in alternatives, then having 2 types of accounts will give you a peace of mind. Bookkeeping will be a lot easier, so you know how much funds you have to spend on medical bills, and then you can watch your investment grow with the self-directed account. The other thing I want to mention is liquidity. So if you have an asset within your HSA and you need to take those funds out because of a medical bill, just keep in mind it might take a few days. If your HSA has a house, it will take a few weeks to sell the house, have the funds come back to the HSA, and then be distributed to you. And again, that's why having 2 types of accounts, the debit card option and the self-directed option, will allow you to keep the funds separate and allow for quicker liquidity within the cash account balance. In order to start an HSA, the process is very simple. We would send you an HSA application, and our fees are the same as the IRA Club custodial fees. And then remember, you can have multiple HSAs. So if you currently have an HSA with your employer, you could also have an HSA here with IRA Club, which will allow you to invest in alternatives. Second step would be to fund the account. You could do an HSA transfer. This is not a taxable event and there's no penalty. The funds are simply moving from one company to IRA Club. Another option is to do a contribution, and most clients do a combination of both. One option that we don't talk about often is an old 401k or an IRA transfer to an HSA. You're only allowed to do this once in your lifetime, so make sure it's the right decision before you do. And the limit of the transfer equals that year's contribution limit. So for example, if you wanted to move over $10,000 from an IRA into your HSA, the limit would be $3,600 because that is the contribution limit for 2021. So again, you can move money over from a 401k or an IRA, but again, once in a lifetime. The third step would be to invest. Find your investment, do your due diligence, run the numbers, and then simply contact IRA Club and provide us with an investment direction form. Our investment team will then review the documents to make sure everything is IRS compliant. So don't forget, if you're starting to look at alternative investments, check out Investors Row on the IRA Club website. This is a great platform giving you different examples of alternative investments, with some of them starting as low as $5,000. You can choose your asset class and dollar amount and see what's best for you. Another great option for the HSA is partnering. When we talked about the contribution limits, you can see that they're not very high. Not as high as an IRA, not as high as a 401k. However, you could partner your HSA either with your IRA or with you or with your LLC. In this example, let's say that you have a self-directed HSA with $25,000 of investable cash. Your self-directed IRA also has $25,000 of investable cash, and you find a great investment for $50,000. The HSA and the IRA will partner with 50% coming from the HSA, 50% coming from the IRA, and together they can make that investment happen. The rule is percentage in, percentage out. So any expenses related to the investment would be paid 50-50, and any profits coming from the investment would also be distributed 50-50%. Let's talk about withdrawing those funds, so taking out a distribution. Earlier I mentioned that you can use these funds to pay for qualified medical expenses, and you can also use those funds to invest. But if you wanted to take the funds out, just keep a few things in mind. If you're 64 or younger and you decide to take the funds out, let's say to buy a jet ski, you would pay taxes along with a 20% early distribution fee. And if you're 65 and older and wanted to take the funds out as a distribution, you would not pay the 20% early distribution fee, you would pay the taxes. So after age 65, if you take the funds out and use it for something other than those qualified medical expenses, the HSA essentially becomes like a traditional IRA. An interesting fact is that majority of HSAs are not invested. They're simply sitting there collecting contributions and maybe making just a little bit of interest. This is where you can stand out. You can utilize your self-directed HSA and invest in alternative assets. Another tip I wanted to share is that if you're able to use personal funds to pay your medical bills, I would do that. That way you're not tapping into your HSA fund. Each time you get a medical bill or you're buying a bottle of aspirin, maybe use your own personal funds and let the HSA funds grow income tax free. In the future, you could also reimburse yourself. So right now, if you use personal funds to pay for bills and prescriptions, you can hold on to those receipts for many, many years and reimburse yourself from the HSA. Now, this will take a lot of organizing and planning, but again, this is a great way to save the funds in the HSA, allowing them to grow income tax free. So does it really matter if I use HSA funds or personal funds? In this quick example, let's say you're 40 years old and you're looking to retire at 65. Let's say on average your annual HSA contribution is about $4,000 and your expected rate of return is 10%, with marginal tax rate being 24%. If you were to use personal funds, your account would be worth $296,849. If you use the HSA, again, you're not being taxed on that profit. Your account would be worth $432,727. So you could see there's a big difference using HSA funds, tax deferred, income tax free, versus personal funds where you're giving a portion of your income to Uncle Sam. If you're looking to start your HSA today, give us a call here at IRA Club, 312-795-0988. You can also email us at info@iraclub.org, and we will see you at the next video.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.